everything just flows. Everyone's working remote. Not only are we working remote, or myself, my entire team's working remote. Other lenders that we send business to, like your Quicken Loans, your United Wholesale Mortgages, those are the two largest companies out there for mortgages.
Yeah.
And their entire teams are working remote. So everyone's remote.
Wow.
So in a normal environment where if you're working in a group and you have a bunch of people around you, you can go, if you have a question, you can just go ask someone. When you work at home, that's not the case, right? You have to call, send an email, and hope that person is there available to respond to you.
At that time.
Necessarily, you could walk into someone's office and get things done.
Yeah.
But that doesn't mean because that person's working from home, it won't happen as efficient. We've seen a little bit of both happen. Some people have kids, right? I mean, I don't have any kids. So for me, I can work and I can work late. My girlfriend understands. She gets what I do. I have flexible hours as a result. She doesn't complain about it, which is awesome because she gets it. And I spoke to her about it. And she understands there are nights where I'm going to be up till 1, 2 in the morning because things have to get done.
Yeah.
Clients have to be responded back to.
Yeah.
But I can imagine those with families. Imagine you got 4 kids at home and you live in a 1,200 square foot house. You're saving grace was to go to the office and get work done. But now you're doing that from home and you're homeschooling your kid. Like that's rough. It's different, right? I mean, that takes some discipline to get work done in that environment.
Oh, who you tell? You just spoke on my life. I'm not at 1,200 square feet, but still, I'm always cognizant of what's going in my daughter's eyes and ears.
Right.
What are they learning? I don't want to just sit them in front of a device, Jeremy.
Right.
I want to teach them something. So it is challenging. I'm pulled into the office. I'm like, do I need to work or do I need to teach them? What do I do? What are they looking at? I mean, it's a lot, big dynamic.
Like some of my employees now, they have kids, right? And I don't mind having a conference call. I'm chatting with my guy and his kids in the background screaming. Like I personally do not mind. And I don't think anyone minds, especially in this environment.
Yeah.
But it's just having everyone understand that there is some flexibility that needs to be given, right?
That's cool, man.
The days of writing a contract and putting a 10-day appraisal contingency, while that can still be done, that's not your norm, right?
Mm-hmm.
Appraisers have to go into these houses and a lot of stuff. We had one appraisal that took close to 3 weeks to come back. I think it depends on each appraiser, and some appraisers bit off a little bit more than they can chew, just with the amount of orders that came in. Because remember, rates before, or I guess while the COVID-19 was happening, they were on a downward trend. Like rates kept going lower compared to last year. So we started the year already getting good. Now you team up COVID-19 and rates, yes, they're at some of the all-time lows that we've never seen before.
This is cool.
It's a weird environment where we can do more loans, but there's only so much capacity because remember, everyone's working from home. So you just got to balance out. Do you put a lot of loans in your pipeline, or do you just kind of like, do you somehow scale with that? And just being a small brokerage, that's my biggest thing is my guy Enoch, he works with me. He said, and sorry for rambling, man.
You're good.
He said, all right, you can go get 4 more loans now, because we had 12 loans closed last week that we've been cultivating, and we have more loans to close, but I've been hesitant on bringing in more loans. And he said, hey, go get 4 more. So by Monday morning, I'm like, there's your 4. Let's keep going.
Holy cow.
Right. It's a cool place to be. Sorry for doing talking, man. It's good to see you.
I'm listening.
It's been a while. What is it? Since April? We haven't seen you. No, we did a talk before then.
I seen you here. I don't know, July maybe.
Yeah.
But I seen you. I follow you around. See, you've been traveling around the world. Are you like a virtual loan closer guy?
Virtual mortgage broker. Yeah, that works. I don't meet with my clients, man. They don't want to meet with me. Who wants to drive half an hour in traffic to go sit down with someone where if they pick up the phone, that could all be done in the same amount of time frame, right?
Wow.
Applications are very straightforward. Even if a client's a first-time home buyer, I mean, I can answer their questions accordingly. I can hop on a video with them. There's multiple ways to convey the process without having clients come into my doorstep, right?
I think it's going to be multiple ways to do all businesses after this.
Right. And it's been nice already doing that already for some time where I'm not panicking.
Nothing new.
I'm
Right,
like, I
exactly.
can already work from home. It's
Nothing new. Keep it rolling. I love it. You know, I'm the same way. I'm like, look, we've been on the internet for the last X. Nothing's new. I've been working, record. You know, so it's almost like let's ramp it up.
Sorry.
Roundup family, thank you for joining us. It's Chris Haskins. You know my mission and ministry to raise your financial literacy through real estate investing and entrepreneurship. Roundup, if you just bear with me, I'm mixing down this Patrick Bet David video. It's gotta be slamming. So it's on the way out. It's on the way. Today I get to hang out with Jeremy Harridath. The man is a virtual mobile loan mortgage broker, but I'm gonna call him today a virtual guy because I don't even need to touch you to get money, right?
Yep. Yeah, that's true.
That is cool. Roundup. The reason I asked Jeremy, go ahead.
No, I was going to say that you sat down with Patrick Bet David not too long ago. I want to hear about that if you have some time at the end, or you can start with that.
Either way, the man, whew, wow. I mean, I literally felt like I went to see the Oracle, Jeremy. And you know, his aura is the same publicly or privately. You know that.
Mm-hmm.
He doesn't change. You sit down when I'm interviewing him, and he's like this, sitting there. I mean, literally like a battery.
Mm-hmm.
Just ready to just pop, you know. I'm just like, damn, this dude is in the seat, bouncing in the seat. I'm like, gracious.
Full of energy. That's awesome. That's awesome.
It was cool, man. Yeah. So we got about an hour and a half of footage. The guy allowed me to stay with him for the remainder of the evening. It was supposed to be 45 minutes.
So is that going to be a live interview for you or for him, or how's that?
It's for me, yeah. I didn't make it on his channel, but shit, I was happy to get any time with the man.
Nice. Very nice.
Yeah.
That's awesome.
That's cool, right?
Yeah, we were supposed to be down in Hollywood. We'll see what happens with COVID-19 if that's going to affect Hollywood.
I would, I've been looking forward to seeing you again and all my people. I'm like, I don't want to do it virtually. I don't know about you.
I'm excited to go, man. I already have my tickets. I have my hotel. Like, I need to cancel it.
I hate to too. Well, he was mentioning when I was there virtually, but he didn't necessarily say he was going to do that. I hope my vote is not to do it virtually. I'm ready to go to Florida.
Right. You and me both, man. You and me both.
Roundup. Jeremy, we're here to talk to you today about the state of the market. Jeremy does a lot of he's done 100. When I first met him, I didn't even know he was a one-man show. Now he's got 5 members of his team. Yep. Done over 100 loans in the last year. I would say you kind of understand FHA, VA, VHDA, conventional financing. I need to know what's going on. Where are we going? Where are we? Give us a picture where we came from in this market, Jeremy. So, because I can buy whatever I want, but I don't count unless I can get taken out by the retail buyer. And a lot of the roundups are the same. Get your questions in, y'all. Get your questions in for Jeremy.
Yeah, so I'm thinking where to start and how I can keep it as simple as possible. What I can say about where we're at now with COVID-19 and the changes that have been happening on a global level. Now everyone's seeing it on their own personal level. You may not, I guess, my audience, I'm trying to speak to the audience. Chris, you got a lot of folks around the US. I'm here based locally in Northern Virginia, in Fairfax. We do business in DC, Maryland, Delaware, and Florida. So I've been seeing a lot of stuff happening within those specific states and counties, but I can see it happening across the US. And what's been happening is, and I hope those watching can relate to this, you're most likely staying at home. You're being told by your government officials that you shouldn't leave the house unless you're going for groceries or any small group meetings of 10 or less. And mainly 2 or less. I mean, the act of not being out and about is talked about across the US because we want to minimize everything that's happening with the virus. Well, as a result of that, your normal type of, or your normal pieces of the transaction is changing. So for example, us as a team, we would typically go into the office a few days a week. We'd work remote a few days a week. Now we're working remote 100% of the time. The lenders that we work with have also adapted policies where they're working remote. So I can say 2 right off the top of my head. United Wholesale Mortgage and Quicken Loans have their employees working remote. Now these are thousands of employees in detailed intricacy parts of the process that can require groups are now individually working remote. Now, as a result of that, and Chris, I was mentioning before we started recording, imagine me, I don't have any kids, so I can work remote. You have other employees who have families at home, and they have 2, 3, 4 kids, and maybe in a smaller confined area where it's a little bit more difficult to work.
Yeah.
That's one thing where things that would normally take a lot quicker are normally taking, they're a lot slower to take place and slower to happen. Your appraisers, for example, typically you would have an appraiser go into a property, appraise the property, leave, create the report, and send it now to the investor or the lender. Some clients now don't want appraisers to come into their properties because of the fear that the appraiser can transmit over the virus to the individual homeowner.
They could,
right?
You never know.
You have real estate, like the real estate industry, they're now doing virtual tours versus having clients walk in the house through their open houses.
I'm cool with that.
At least we're seeing a lot of that shrink a bit, and it's becoming less and less until eventually we may not even have open houses in the near future.
Well, Jeremy, we've already been kind of touching the virtual house, just being able to put the glasses on. I mean, do you think this might even give us a push towards that, perhaps?
Could be. It's definitely happening more and more day after day. We are seeing some flexibilities with, let's just say, appraisals. So Fannie Mae and Freddie Mac, even Ginnie Mae, had put out some guidance on the way appraisals are done. So depending on the lender, depending on the circumstance, we can do a full appraisal, a drive-by appraisal, or a desktop appraisal, meaning the appraiser can be creative if he's not able to get into the property.
Gotcha.
We're also seeing Fannie Mae and Freddie Mac bend a little bit more with the flexibility of getting an appraisal waiver. So for example, if a client's putting 10% down on a Fannie Mae loan and we run our automated findings through Desktop Originator, Fannie Mae may waive the appraisal based on other market data surrounding that one house.
Gotcha.
Does that make sense?
Yep.
Because remember, every time appraisers do an appraisal, all that information gets logged somewhere.
It's logged in, yeah.
Now that technology is available to allow Fannie Mae to determine if an appraisal is needed or not. So we're actually doing more and more transactions with no appraisals because we're being given that waiver.
The data's already in the system and the computer can pull it.
Yep. We're seeing that more and more with refinances. We're having clients come to us who think they may be at 80%, and then we're able to crunch the numbers in our system. And based on Fannie Mae or Freddie Mac's data, we're able to go back to the client, present them an offer, and go, we don't need an appraisal with this.
Nice.
If you're okay with the numbers and you're okay with the value that's given, you have the option of choosing no appraisal. And we can just keep moving forward, and we'll save you $500 along the way.
Yeah.
It's huge.
It's huge.
I actually just sold a condo, and I had put it on the market.
You personally?
I personally just sold it. Right?
Okay.
And I got
it. Northern Virginia, DC?
Yeah. It was in Fairfax, Virginia.
Okay. Well, for round-uppers that are from California, that's Northern Virginia. The market there is just crazy.
It's Fairfax, Virginia. The condo was in Fairfax, and I got an offer for 20% down. And I noticed there was an appraisal contingency. So I got a little creative, and I found out that I don't need an appraisal.
Wow.
And I was able to counter back over the listing price because it was the first offer before an open house, and they wanted me to cancel the open house, which I was hesitant on. But I countered $5,000 over the asking price, waiving the appraisal, knowing that the appraisal can be waived. And I had the listing agent reach out to the lender to tell the lender that he can waive the appraisal.
Nice.
And of course, we had the contract ratified, waiving an appraisal of $5,000 over asking.
Wow.
And I've done that even with our clients. So I've had clients go to put 10, 15, 20% down, and we've even recommended waiving the appraisal, and they've won contracts as a result of that. Right.
Give me the lender's mindset. I want my round-uppers to understand you're putting down 20%. What is the mindset of the lender waiving that appraisal?
I mean, Fannie Mae is going to accept it. It's not necessarily us. It's Fannie Mae and Freddie Mac going, we accept the value you're putting. If you're doing 10% down or whatever the parameter is, and Fannie Mae gives that waiver, that client can take that approval and that waiver and take it all the way to closing.
That's sharp, man.
Giving no other substantial changes happens in their circumstance, in which the loan originator has to make sure that file was run correctly from the beginning, that it just wasn't, excuse my French, half-assed for approval, right? It has to be somewhat of an accurate approval that was run from the beginning. Can minor changes happen? Yes, but you want to make sure nothing substantial changes.
Well, if I'm a lender and I have someone putting down 20%, my thing is, look, you putting down 20%. I mean, I would the least I would be able to do is save you that money. I mean, you got a lot of skin in the game on that.
Right. Keep in mind, it's not guaranteed. You have to get it through Fannie Mae.
Generally speaking,
you have to receive the approval. But if it's there, we run with it.
Nice.
We haven't had any lenders go, no, we're not accepting this.
So let me ask you, Jeremy, where are we at? I want to see your business 30 days, 45 days ago to where you're at now. And then I want to get into the stuff that's changing for my borrowers that are taking us out.
So I set a piece last year. My LLC was set up in January. We didn't start originating until March, and our first loan closed in April. Now, we have just stayed consistent over the last year. I added some team members to help me in the process. So we've been working on our systems, creating some process flows that are more streamlined. And one thing that I was actually changing before all this happened was I was changing my origination system to a more efficient origination system. Because when I started, it was just me. It didn't really matter. Now I'm trying to get something in place where my entire team can use it and other loan officers as they come on. And it's fluent. It works, right? It's scalable. So as I'm switching over this origination system, our pipeline, when I don't do that much business. I typically have a pipeline of 10 to 20 loans at all times. Mm-hmm. Our pipeline grew at 40 something. It almost tripled from where we were within the last 30 days.
Say that again. I didn't say that again.
Our pipeline tripled. So we went from 10 to 15 loans to a little over 45 loans in our pipeline in a matter of 2 weeks. And more switching systems, and everyone's now working from home. And as all this was happening, I'm going, we're not ready to work from home yet. Like I didn't have my pieces in play for everyone to go fully remote. But ever since then, we've been having a call every morning at 9:30. The system's intact. We're still working out some kinks, but now we can look at all the loans we have, and now we've been broken a bigger pipeline than what we're used to.
So are you telling me that your business has gone up ever since the virus situation has come around?
Correct. We haven't focused, and even since I opened up the brokerage, we haven't focused more on purchases, even though I have always been a more purchase-centric loan officer. But over the last year, as business comes in, that's how we're handling it.
What are you focusing on, Jeremy?
Creating a better process flow.
I'm talking about, you say you don't focus on purchases. What?
I was, so.
You do refis, or what are you doing?
I'm about 50-50 now. I've always been about 75-25 or 80-20.
80 what?
Percent purchases.
Okay, 80% purchases.
Correct.
20%.
I'm more refinance heavy than purchase heavy. Because the market permits. You have, and the analogy that was given, especially when the market kept getting better and better, is I heard someone else reference it. So forgive the how strong it may be. Imagine you're in a rock concert, right? And there's 20,000 people in a rock concert, and all 20,000 people take a laxative. How many bathrooms are there for everyone to go with, right? And what that caused in the mortgage industry was a supply and demand issue. So when going back 30 days, when you asked me what's happening in the market, it started going lower and lower and lower. Investors, or these lenders, starting getting busier and busier and busier. But now you have everyone who wants to refinance that clogged a lot.
Oh,
and instead of rates continuing to go down, you may have noticed that rates started going up.
I see.
Because lenders had to artificially increase their rates because they had more business coming in than they can handle, right? So I had friends in some banks saying they were at 90 to 120 days for a process.
Oh my Lord.
I've heard a lot of stuff. Some lenders kept it at 1 to 2 days in process. And as a broker, we have access to 30 different investors. But we saw some investors that we normally use go from all of a sudden your low 3s to your high 4s. Just because they didn't want to get more business at that high of a frequency.
Holy cow, just
now,
crazy.
Today, we have investors pricing in the 3s, low 3s, and we have investors pricing in the high 4s.
Either way is good.
Huge spectrum of business. Now, you team that up with COVID-19, you have the government passing along a stimulus. You have you remember the non-QM market, your bank statement loans, your debt service ratio loans,
They were coming back though. I thought I've seen them coming back in the market.
Well, a lot of companies took a pause and some even shut their doors.
This is 30 days ago.
It's 30 days ago.
Gotcha.
I mean, my time frame now is all skewed. I guess all being at home, but this has happened relatively in the last 30 days.
Yeah, gotcha.
You had a lot of investors who bought these loans on the secondary market go, I don't want to buy these loans anymore. Now, all of a sudden you have loans that are funded and you want to put it in the secondary market. And now all the investors that typically would buy these loans are going, I ain't buying them.
That's bad. I mean, that leads to a downfall, correct?
That led to a lot of loans that were in process for non-QM, and knock on wood, we didn't have any of those loans in our pipeline, but those loans, they didn't have a home anymore. Clients in process. I heard stories about buybacks and not having a place to actually put them. And now these lenders have to keep them on their books because they don't have a place to put them.
Now, did that hurt people that were buying? Jeremy, I got to kind of bring you down. You're at 40,000 feet. We're talking industry jargon. I got to bring you down to 10,000 feet. Break that down to the pain of the borrower going to closing. So you're saying we didn't have somebody to buy on the secondary.
Yeah, so those loans
that picture
cut before loans are funded. I mean, again, I'm part of a few Facebook groups, and I see different things happening as they come out. I've seen interviews over the last 30 days just to get updated on what's happening in the market. But essentially, your bank statement loans, if you came to me for a bank statement loan, I don't even know if I have an investor, just because all my normal go-tos don't offer them anymore.
And you not having an investor means what for the borrower, Jeremy?
If I don't have an investor, then I have no place to broker that loan out to. And if I don't have a home for them. So if you want to get a bank statement loan and my normal 10 investors, maybe one of them still do them, I only have one solution as opposed to having 10 solutions, right? So my ability to find a home for a loan, there's not people buying them, or at least the investors are not buying them, right? And this was 30 days ago. Some things may have changed between now and then, but I haven't seen any investors that I do business with say we're offering bank statement loans again.
So that means the loan's denied for the borrower.
Denied, yes. Yeah, there's no loan for them, right? It's only a loan if you can get the money at the end. But now the person who gives you the money at the end is going, I don't care if you're in process or not. I'm not buying it. I don't care what sad story you have. Like they don't care. From what I've heard, these investors don't care about circumstances. If they don't want to buy because it's not a safe investment, they're not going to buy it.
You can't blame them, Jeremy. It's my money. I mean, why am I going to go buy a toxic asset? That's what blew us up in 07, 08.
And I don't know if you've heard about government loans, about the credit scores increasing. Have you?
That's what I want to talk about. I'm coming. Paint the picture for me, Jeremy. I'm coming to you to get a loan. Tell me what's changing inside.
It started with the non-QM market pretty much dissolving about 30 days ago.
But that's for people that want a loan just based on docs.
Bank statement. Correct. Then what started happening is the government created a stimulus. They started buying mortgage-backed securities. Now, if someone wants to know more about this, I'm not here to explain what each mortgage-backed security is and give definitions. I recommend doing some research. There are some good tools that I can send over to you, Chris, that you can relay to your team, that if someone wants to get more research and get some of the nitty-gritty on this, I'm happy to share it. I'm kind of just summarizing it, so I'm not.
We want a summary. Yeah, we want your summary
from a 40-foot ledge. But the government started buying mortgage-backed securities at a bigger amount than they normally do. And what happens whenever there's a lot of, so to backtrack again, and this will all come together, a lot of mortgage companies hedge on the market. They hedge on the back end, hoping that the market doesn't have tremendous sways, right? Ups or downs in a very drastic manner. Well, when the Fed started buying mortgage-backed securities, there started to be some swaying. And what happened was a lot of these lenders, whenever there's a sway so big, the brokers that lend these money to the lenders went, well, if the sway is too high, they have to pay that difference on the hedge even before the loan is closed.
All right, you're talking to 40,000 again. I need to bring it down to 10, Jay. I can't understand what you're saying.
I'll do that. Rates started increasing for a lot of companies because they didn't want to take more loans because they were losing money to the hedge.
Gotcha.
In short, if you call your local lender and you get a rate from that lender, then you call a broker and then you call a bank, you're going to get a wide variety of rates between the two.
Gotcha.
That's what it comes down to. The risk being taken on the back end is not as great as it used to because of the volatility in the market. Okay. Now, what's happening with government loans is while this was happening with the government buying mortgage-backed securities, you may have heard about forbearance coming up, about different politicians started talking about skipping your mortgage and not making your mortgage payment. And now all of a sudden the government goes, well, you don't have to make your mortgage payment. And then everyone starts calling their servicer going, I don't want to make my mortgage payment. Now, keep in mind, all this is happening just over the news before anything comes, that's solid, that before even guidelines are drafted on forbearance and how this would all look. You have a lot of clients who want to skip their mortgage payment.
No guidelines.
Here's the problem with that. If you have a government loan, if we do a loan for a client that's a government loan, so your FHA or VA loans, and your client or the client doesn't pay that mortgage, then that servicer or whoever services the loan has to ensure that that payment is being made. So if you now have a portfolio of $100 million, let's just say, and all those clients stop paying their mortgage, and that servicer has to now pay that mortgage payment, they may not have enough money to keep up with that. Maybe 1 month, 2 months. How long can one company pay mortgage payments? Because remember, that's real money. If a client's not paying it, someone is. And if that servicer is paying it, that servicer can possibly go out of business as a result.
That's nasty.
Right. I mean, there's a lot of talks on the back end regarding that. That's why a lot of companies are increasing their credit score requirements.
Let's get to that.
A lower credit score borrower has a higher chance of not making their payment.
Let's get to that, Jay. Jay, I got to reintroduce you. People coming, going round up. Thanks for coming.
I'm all over the place, man. I'm trying to keep it as simple as possible. It's been interesting in the last 30 days. Jeremy
Harridath, we're at home, stranded, can't leave the house. He's working closing loans at the house. Rounduppers, get your questions in on. I want to know what's going on with retail buyers. Jeremy's been in the business for quite a while, but he did 100 loans in the last year. So, Jeremy, tell me about credit. What's changing? What do people need to worry about as we're going to qualify our buyers?
Sure. So here's some short answers. If you can make your mortgage payment, if you have a mortgage and you're debating if you should use the forbearance option given to you by your servicer, my thought is if you can make your payment, make your payment. It was your commitment to make a payment. Not making your payment can hurt the system as a whole. Plus, if you do decide to go the forbearance route, read the fine print. There are a lot of companies out there that I've seen with guidelines where, yeah, you could skip your 1 payment, 2 payments, 3 payments. But when you're making your 4th payment, you're paying all those payments in one lump sum. And if you can't do that, so for example, month 1, $2,000, month 2, $2,000, month 3, $2,000.
Add up.
When you go to make
Add
your
up.
payment, you're going to have to owe $8,000.
Adds up.
Keep that in mind, right? If you have issues, let your servicer know, right? Don't assume that if you don't call your servicer, you don't have to make your payment, because one, they can put a 30-day lateness and that'll hurt you in the long run.
Yeah.
If you go under a forbearance and you truly can't make your payment, understand at the 4th year, you may have to create a modification or something to figure out how to keep your home, right?
Hold tight, Jeremy. I got to get you, for my rounduppers that may not understand fully what a forbearance and modification, just give us the short version. Forbearance.
Forbearance is not making your payment and deferring that payment to a later time.
Later in time.
Each servicer or lender or bank, whoever you pay your mortgage to, has different guidelines set up. Because there are different guidelines, there's no one size fits all. So I can't tell you this is a forbearance and this is what it's going to look like.
Gotcha.
No, go to your servicer, find out the details. Keep in mind, the guy that you talk to on the phone, he or she may not know the fine print. Don't go based on what one person says. Mm-hmm. Get it in black and white, read through the fine print, and understand what it would look like if you were to not make your mortgage payment.
Gotcha.
Does that make sense, Chris?
Yep.
And again, if you, Fannie Mae has already said, and double check, please, with if you're moving forward with a lender, or even if you're asking the servicer about getting forbearance. But from my understanding, from some of my lenders, they've said if you're in forbearance and you want to refinance, you can't refinance.
Gotcha.
You can't have a mortgage that's in forbearance and then want to refinance your loan.
Move that money around.
And a lot of guidelines, mortgage guidelines, look for a 12-month payment history.
Yeah.
We don't know what it's going to look like if someone did go under forbearance, didn't make a 3 months mortgage payment. If that's not reporting on their mortgage, what it would look like when someone has to show that they've made their payments for the last 12 months.
Gotcha.
So all that is still uncertain. Don't take the risk. If you can pay your mortgage,
just pay it. Yeah. Mortgage. That's where I was at.
I'm trying not to be mean by saying that, but I mean, it was an obligation that you set up for 30 years, 15 years, 20 years, whatever your term was.
Mm-hmm.
It's a matter of financial responsibility that if you do have any sort of debt and you can't pay it, you should have some reserves set up, some liquid cash set up for circumstances like this.
So we're going to closing, Jay. What are our credit score requirements changing in your world? So
my world, FHA and VA still has a guideline for a credit score of 500.
500.
We have investors. I haven't pulled up a 500 recently. We don't do too much of those. But I had one I pulled up for 550. There were a few investors that popped up. We just closed one today.
You can see this stuff. You pull it up online and look right at it, whatever back office you have.
Correct. Not only can we price loans with investors, we can go through their guidelines. We get guideline changes on a daily basis.
Gotcha.
We've had, and it's still coming. It hasn't happened yet. Remember, this is all evolving
every week.
So it's anything I say today may not be valid next week, right? Wow. So while I do have investors at 550, I have investors at 580, 600, 620. I know a lot of lenders have also put 680 as their minimum FICO score. And again, the reason for that is when unemployment is increasing, it was 3.3 million, however long ago, 6 million, whatever the number is today, I don't know.
Mm-hmm. High.
If you get a mortgage and you don't make your first payment, that loan is not saleable on the secondary market. If that loan isn't saleable on the secondary market, then that loan has to stay with the servicer, and that servicer has to now keep that loan on their portfolio. Remember, not everyone can keep their loan on a portfolio. Not everyone's set up liquidity-wise to do so. So now you're having clients who are purchasing these houses who may or may not lose their job within the next few days, weeks.
You don't know.
But statistically, the lower credit score borrowers have a higher chance of not making payments.
Gotcha.
They have a higher chance of foreclosing or having a short sale due to a lower credit score.
I'm sorry.
No, what I've learned is just because of a client has a lower score doesn't mean they're bad at managing their finances. It could be a one-time blip. It can be whatever it may be. for example, a divorce scenario. If you had a client who was going through a divorce and their credit got tarnished because they had a joint account with their spouse, that the spouse ran up and didn't pay, that now falls on our client who has a lower credit score, but the client has a history of managing their credit through other trade lines, right? So there's different ways to determine if a client truly does not know how to manage their finances. And we don't even dictate that. When we run loans through FHA or VA, they'll tell us if the loan's going to be approved or not. There's an algorithm that's run on the back end. So even though we can do 580, 600 credit scores, doesn't mean that loan will be approved.
Are the 500 scores, are those loans better or worse than the 680? Somebody that, I mean, since they've now, has FHA raised the credit requirement? How is it changing, Jeremy?
Each lender has their own set of guidelines.
All of them are different.
Each lender has their own guidelines, correct. We have investors, when we set up the brokerage, we have investors that go down that low just because we want to be able to help a wider variety of clients. Majority of our files are, I would say 67% of our files are conventional, while 33% are FHA and VA. So we have a wide spectrum of different clients. But
when you say conventional, what do you mean by that, Jeremy, as opposed to FHA? Paint that picture.
Just if you take 100 of the loans that we closed over the last year, 67% or 67 of them were conventional. While
what is conventional? What does that mean to me?
Fannie Mae or your Freddie Mac loan.
What does that mean? I'm when you say conventional.
Good question. So I'll break it down a little bit more. So you have your FHA loan, which is your 500 credit score or higher.
Okay.
Typically from 500 to 579, you're putting 10% down because that's the minimum required for FHA.
Okay.
580 plus, there's a minimum required of 3.5% down.
Okay.
Conventional loans, so your Fannie Mae or Freddie Mac loan, there's a minimum credit score of 620.
Okay.
With a minimum down payment up to your county limit of 3%. I can explain that later if someone has questions, or 5% if it's a high balance loan.
What's the difference? They sound the same to me. I heard
I'm trying to keep it on a
10,000. 10,000. Yeah, 10,000. Don't go to 40 on me. You can't go to 40.
And then you have your VA loans where a client's financing 100% of the property. We can do those down to 500. Again,
wow.
But keep in mind, just because the client has a score and they meet the guideline parameters, they have to be approved through the FHA or VA or Fannie Freddie algorithm for an approval. The system tells us if it's going to be approved. We don't necessarily make that determination. We just plug in the data points as they are and run it through. And if we have an approval, then we can proceed with the loan.
Round up, get your questions in. Jeremy Harridath, mortgage broker. I want to know I'm nervous. Are you nervous at all, Jeremy?
Not necessarily.
Why?
I feel pretty confident about where we are and where we're going. One as a company and as a nation. That's just my thought process on where we are. I'm not necessarily a panic streaking person. I mean, I've been following COVID-19 since there was one death in China months ago.
Oh yeah.
So because we went to Colombia and Kenya.
That's right. You traveling.
Yeah. And in Kenya, I was looking at it morning and night, just watching it grow because again, we're going to an international airport. There was a lot of hesitation on how we would get back and if we'd get back, and we were kind of glad we were back and we had no issues, right? Yeah. The folks I traveled with came back safe.
That's cool.
But I've seen it evolve. I mean, we were buying stuff. I didn't say we hoarded toilet paper, but we have an extra 12 pack of toilet paper, right? We have canned goods just in case something goes wrong.
Happens. Could happen.
We set ourselves up so we can win, right? We didn't wait for something to go wrong.
Sure.
To try and figure it out. We're trying to do as much preventive maintenance as possible. But going back to that what's happening 30 days ago to where it can happen in the future. Remember, unemployment's been rising, right? So you're having clients who are getting these FHA loans 30 days ago with a 580 credit score, even before these scores started increasing. Some lenders started kicking these clients midway through the process.
When you say kicking, what does that mean, Jeremy?
We're not going to do your loan anymore.
Halfway through the buying process? I got my contract accepted. I'm paying for an appraisal, home inspection.
Yep.
Oh, my Lord. Wow. That's rough.
Interesting. Yeah. Some have honored it and kept closing clients, no issues. The hesitation is
what happens to those families, Jay? I mean, I'm thinking about people moving. I mean,
they
how
find
does
a broker like me who can figure it out for them? That's the short answer.
Holy cow.
We can still do them. Like we've had clients reach out who have 620 who can't get a loan elsewhere because the lender changed their guideline.
But doesn't that have an adverse effect on the seller? I'm thinking I'm the investor. I'm selling that house.
It's different times. We're not in your normal market.
Holy cow.
And again, the reason behind this is, remember, unemployment's increasing. I don't know if it's going to continue increasing. These people who now just bought a house, now who don't have reserves, now don't have a job.
Yeah.
Or the government told them they can skip their mortgage payment. And because they just bought a house, they request their mortgage to be skipped. What that does is you don't have a home for that loan anymore.
Mm-hmm.
And now you're having more and more servicers keep these loans that are not supposed to be on their books because they're non-saleable loans.
Yeah, that's nasty.
It ties up their lines. It doesn't allow them to do business they normally would. And it has an adverse effect on the market as a whole. So if you pay your mortgage payment, pay it, right? If you're buying a house and your first payment's due on May 1st, I don't care what the government said, pay your loan. Like, understand that it takes money to keep the market moving. And it's
current.
Well, the moment that stops, I mean, the mortgage market will be the least of your worries at that point.
That is true.
There's a trickle-down effect everywhere with any decision that's made.
So as things are slowing down, you're telling me loans are stopping as people are going into closing. How do you think? Where are we going, Jeremy?
We haven't had that issue, and we had one client we put in with a lower credit score. It was a 620 credit score. It's a good score, and the lender changed their credit score requirements. What we did is we just locked it somewhere else, and now the client's in process somewhere else.
So lenders are changing credit score requirements.
Yes, like there are a lot of companies out there who have adjusted already to 680. Again, we still
from what, Jay? From what? From give me a perspective.
I had one investor who goes down to 580. They increased it to 620. I know I have a lot of different friends in the mortgage industry. I have one that I know they go down to 600. They increased it to 680. I mean, you can use your imagination how
you're seeing them. That's all. I want you to. So, Jeremy, when you say investor, help us understand. Are these investors people that you're placing loans to when you write these loans?
They can be your Quicken Loans. They could be your United Wholesales. They could be your Penny Macs. They could be your whoever it may be.
These are homes for your borrowers.
Correct. I mean, even some of your banks, your local banks have changed their guidelines, right?
Wow.
Now we only have 30 investors that we send business to. I think 30 is a lot, but there are a lot more companies we could do business with. I mean, we're still a newish company, but it's evolving. That's probably the best way I can say it.
How about cash reserves, Jeremy? Are you saying lenders want to say, listen, I need you to have 6 months or 4 months?
Yep. We had one client who we submitted for a clear to close. And
clear to close means you're going to closing.
Clear to close means you're going to closing. And one of their updated guidelines due to COVID-19 was if a client has a rental property, they need to have 6 months reserves for that rental property in their.
On top of the reserve for the loan that they're getting.
They didn't need. It's a primary residence, so they didn't need reserves.
Okay.
You wouldn't be surprised if other lenders put out reserves. Requirements. Remember, when someone puts a guideline out, in this case, 6 months reserves are needed for a rental property that they own, even though they didn't need it for their primary purchase, that's a company overlay. You're getting more and more company overlays, and they can get creative. I've seen some with, if you have a credit score under 680, you need X amount of reserves. If you have a score over 680, you need X amount of reserves, and they all differ. Like it's your Fannie Mae, Freddie Mac guidelines anymore.
Wow.
And because it's each company determines their own guidelines. Mm-hmm. Remember, there are banks, your local mortgage company, your broker,
credit unions.
Everyone has their own guidelines. So there's no like, here's the guideline change for the industry as a whole.
Across the board.
No, talk to your loan officer, talk to your broker, make sure your loan officer gets your scenario, right? I happen to know that client had a 401k, so it was no issue. I just put in the 401k and we solved the issue like that and we kept moving on. But if I didn't know that and a guideline change happened, we would have had that loan be declined.
Wow.
The client didn't have 6 months reserves.
Oh man, Roundup, thanks for joining us. I've got you for 45 minutes, Jeremy. I got a few questions here, man. I don't want to take up your whole day.
I have all this bundled up inside over the last 30 days, man. You're like the second person I've talked to. No, actually not the second. I talked to the team too, but
hey, yeah, we're all bundled, we're all locked down, right?
It's fun, man. It's for my recommendation is if you have someone watching this who's going, damn, my lease ends in June. I want to move. I want to buy a house. I can answer that from Jed.
We'll get to that. Keep going. I'll read the question because sometimes I have a lot of people that don't see the YouTube, so I have to read it out. Go ahead. I'm listening. The last thing you said, the final, what you were saying?
Yeah. If someone's thinking about buying a house and their lease ends in June or within the next 6 months, don't be deterred by this. I mean, go out and do business as normal. Right, your approach to buying a house may be different. You may not be able to go look at 30 houses to determine which house you want to get. Call an agent, figure out what their method is to show you houses. Call your local mortgage broker, call your bank, call your local lender, call whoever you want. I'll be happy if you call me, but you don't have to call me. But call whoever it is, find out what their guidelines are, make an application with them, find out what you can buy, and just go do it. Don't be deterred thinking, oh, well, if the market crashes in 12 months, I want to buy then. Or if rates drop to 1%, I'm going to buy then. Like, no one knows what's going to happen in the future. If it makes sense now, do it now. It's like the clients that I talk numbers with about locking loans or moving forward. It's if the numbers make sense now, why mess around with it? Just lock it in and let's get this closing in 30 to 45 days.
Well, should people be concerned, Jeremy, regarding the value? Say I'm buying a $300,000 house today, but I am getting a nice interest rate. Would I be concerned maybe next year it's worth $250,000? I mean, what is your thoughts on that?
What if it's worth $350,000?
So right? You're saying I'm not saying it's good or bad. I just want to know your opinion. That's all, bro.
Remember, a recession doesn't mean a house in crisis, which means there's no guarantee that values are going to drop.
Either way,
guarantee that rates are going to continue tanking. No one knows. We have to see how we get through the next 3 to 6 months as an industry, especially these mortgage servicers, to make sure that there's no issues with liquidity. Would we see some companies fail during this time? Possibly, which is why I'm saying if you can make your mortgage payment, make it. Because again, you not making it when you have the capacity to make it can hurt the industry as a whole.
Okay.
But does that make sense?
Yeah, I got you. Roundup, thanks for joining us today. I'm with my boy Jeremy, mortgage broker. Don't forget, I got 50% off all the training with Jessica, all Eddie's stuff on my website. Use the coupon code HOPE. We will get through this. I have no idea when. Use the coupon code HOPE. Head on over to Chris Haskins. Get all my training half off. Roundup. Let's get to some Q&A, my brother. Mr. Jed had a question. Mr. Jed, hey, Jeremy, how low do you expect mortgage rates to go?
I don't know. It's really hard to say. A lot of experts say they're going to get lower. I used to read articles years ago when these experts said rates should be in the 5s and be higher from there.
This was when was this?
I remember reading all these reports on what the experts say the market should be. Down the line. A year passed, and I'm like, we didn't hit that. Like, no one knows what's going to happen. This can all blow over in 6 to 9 months, or it can lead to something greater.
Well, my thing is with Jed, if the rates are low now, they're low now. How far lower can they go? It's going to take some time to tell. But I think Jeremy is saying, listen, and even for me, we're looking for a house too. I'm like, man, 3.7. To me, 3.7 is like when I look at a scale, it's like close to 0. I mean, you got 1 to 5 to 10. What is your opinion on that, Jay?
I mean, I can't necessarily quote rates on this video, nor am I guaranteeing rates because I have to give all my disclaimers and APRs. And
we won't shoot you in the head if you have something that's wrong.
After I say a number.
We're not going to shoot you, brother.
We've just this week we've already locked loans in the very low threes.
Low threes.
Low threes. So if you're getting a loan and someone's giving you 375, I should talk to you, man. I mean, hey, I can help that. Here's what we're noticing, right? I mean, not rates are they're low, but not everywhere is it like that. I talked to a buddy who works at a local mortgage company, and their company stopped hedging loans on the back end, and his rates were in the fours.
What do you mean they stop hedging loans on the back end, Jeremy? Bring it down.
Taking additional risk to make additional money on the back end. That's
okay.
The best way to say it. They stopped doing that, and a lot of the investors they do business with increase their rates. Their rates they're higher, and they can't offer a 3.25% interest rate without charging points. For the same scenario where if someone came to me, I have an investor who can possibly do it for that without points. Right? It's just a client should consider their options and not go with the first person to give them a rate. Let's just say a client gets a rate from me and they go to 3 other places and the rate's the same, maybe an eighth lower, eighth higher. They can make a decision on who they want to do business with. But if I give them a rate and someone gives them a rate of 0.5% more, then you know that person's out of the game and they shouldn't do business with that person at this particular time.
For people that go ahead.
Rate, right? I'm not downplaying rate. I think we have some of the lowest rates in the industry, but rate isn't your only thing to get you settlement. It's the process. Does this person know their due diligence? Is this person going to get me to settlement? Is this person going to fight for me to get me to settlement? It's beyond rate at that point. It's the ability to deliver.
You're talking about a broker.
Any bank, right? Okay. I mean, I know some banks who are still very quick on their timeline and some who are taking forever. I know they're quick because their rates are higher. I have friends that I talk to in banks, local mortgage companies, and other brokers. So I try to get a pulse on the market with different industry outlets.
Wow. So I think I'm trying to paint the picture for my viewers. Perhaps using you can shop the deal to the best that's for the borrower. Correct. As opposed to going to one lender.
Right. And even if they do go talk to someone else besides me, use your best judgment. My rates shouldn't be 0.5 point higher than someone else.
I see what you're saying.
I don't think so. That shouldn't be the case. But yeah.
Williams, thoughts on recasting versus refinancing a current mortgage and suspension of mortgage versus deferment versus forbearance. You guys got this industry jargon. Good God Almighty. Sure. Break it down I have no idea. This is
sure. So recast
Williams. Good.
Let's just say you finance a $200,000 house and you pay it down $50,000.
Gotcha.
If you recast the loan, you re-amortize the loan based on the remaining term. But now
I love that
50 level as opposed to 200, so you lower your payment, which can save you interest over time.
Are lenders doing that?
Yeah, they've always been doing that. That's
what?
Yeah. But if you refinance at whatever the current balance is currently and the lower interest rate. It's not just when you recast, you keep it at the same rate. When you refinance, you do it at a lower rate.
Gotcha.
And if you ended up paying down your balance, a lot of companies, they have a guideline where you have to pay it down by $10,000 or more in order to recast it. Check with your servicer, right? Each servicer has different guidelines. But if you can get a lower rate of interest, then refinance.
Gotcha.
Suspension of mortgage versus deferment versus forbearance, just make your mortgage payment. If you can't make your mortgage payment, call your servicer. I don't want to give specific guidance on 1, 2, or 3 because I just think everyone should make their mortgage payment, especially during this time.
I think Jeremy wants us to make our mortgage payments round up, even if you got like me.
Payment, right? Your housing payment and food are very important. If you don't make your housing payment, make your housing.
Jeremy doesn't eat if you don't make your payment. I think that's where we're going with this. Williams, a government-backed Fannie Freddie, FHA, MIP. Yes, true. When in default, insurance kicks in, but when the bank sells, aren't they going to get paid twice? Good question.
I don't have an answer for that.
They got that MIP.
I want a recommended answer. I mean,
he wants you to pay
your mortgage. Yeah,
sure. But Jeremy, I'm a waitress. I'm a bartender. My restaurant shut down for the last 30 days. What do you expect me to do?
Habit of Savings, Napoleon Hill. The book is called The Laws of Success. That person should have been saving for a rainy day from the get-go.
Gotcha. Mr. Transaction, how hard will the market be affected from the new foreclosures that are on the way based on these people that we just talked about?
Sure. So if there are foreclosures, there can be a driving down in values in that neighborhood. There's a possibility. I didn't go through 2008, 2009. I don't know what's going to happen in the future. I think there's a lot of money out there where, depending on the area you're in, for example, the Northern Virginia area, Arlington, DC, certain parts of Maryland, they're not going to be affected as much because they're more government employees. While some of your other areas in the country can be harder hit as a result of foreclosures.
Big time. I think you're insulated, Jeremy.
Again, just because it's a recession doesn't mean it's a housing crisis, right?
Yeah.
There's no guarantee of a foreclosure happening if someone has a forbearance set up with their lender. But again, read the fine print. And I said this earlier, if someone doesn't pay their mortgage payment for 3 months, some servicers will require that all the mortgage payments be made on that 4th payment. Not all of them do, but make sure you read the fine print. Because again, that person would have to go into a modification or figure out a way to sell the property if they're not able to pay it. Does that make sense?
Yep, gotcha.
There's no guarantee that there'll be a high amount of foreclosures as a result of what we're going through.
I want to answer this one. Khalil wants to know why we look like we're in our mama's basements. I work from home, Khalil. I work from home. I don't know about Jeremy.
I got some windows, but they'd affect the camera quality. So
we work from home, my friend. We work from home. I'm happy about that. Let's see. Question. TB. Have you noticed DPA? Down payment. Thank you. The acronym.
Down payment assistance. Yeah, there are some bond programs that are slowing or not being offered. We haven't been heavy in down payment assistance. So we're not affected by it as much. We don't have too many clients that use down payment. Actually, we don't have any clients that use down payment assistance.
Gotcha. So you can't even really speak on it. Oh, is that what you're saying?
I've heard of down payment assistance being reduced for other programs.
Well, that's going to hurt the buyers, correct? The borrowers.
That can potentially hurt them. Yes.
Mr. Nath, in regard to the temporary mortgage suspension that Jeremy hates, that being 90 days, would it be a question of ethics if you're required to pay back the full amount on the 4th month? That's just juicy for you, Jeremy. You could bite all into that.
I don't make the rules, right?
Matter of fact, never mind.
The government set this up, I think, with the anticipation of having less foreclosures and not going into some sort of housing crisis. Keep in mind that Chris, if I give you $5 and you're supposed to give me $1 each month to pay it off, and you lose your job, you still borrowed $5, right?
Yes.
You signed that you would pay regardless, that you would make the payment. Yes, you lost your job. All right, dude, well, you still owe the $5 because that money is being used elsewhere, right? They're counting on that money to come in so it can be used elsewhere. Now, if some do that, it's okay. It's part of the normal calculations of it being done. But if everyone does it, it's an issue, right? The money can't be used for what its intended purposes. The money has to be paid back or guaranteed because you have a FHA or VA loan. It just causes more issues. So there's a huge liquidity issue that comes up with this. And yes, you could call it an ethics thing, but they're the ones lending the money versus not being in at all.
I think we got a bigger issue here, Jeremy, as opposed to just the system, how it's set up with that mortgage-backed securities. And I'm not saying that you're part of it. I'm just saying this whole derivatives.
I heard someone give a good analogy, and I posted it to my Facebook the other day, and I'll try to sum it up. Let's just say a bunch of Americans are mad, and the government solution is to give them 1,000 pounds of ice cream. Well, now you have all these Americans eating all these ice cream, and now they get fat and they get diabetes, and now they go to the hospitals, and the hospital gets blamed for not being able to take care of all these people with diabetes. Whoops. You can't expect to give America free housing payments and then blame independent mortgage bankers for why they couldn't handle this.
The system, yeah.
Yeah.
System, my brother.
I'm very strong on managing finances, right?
I
Everyone,
like that about you, Jeremy.
you shouldn't make money and not save any of it.
You should save.
I'm a hard believer in that.
That comes with time, though, my brother. Not if we don't come out of the womb understanding savings.
Well, I think if someone is getting a mortgage and they're borrowing money, they should understand that if they can't pay that money back, there are possible consequences, which is a 30-day lateness on your credit report, right?
They're not going to kill you if you don't pay.
It's so very easy to get a loan. It's push button, get loan, but there are no consequences, or the consequences aren't explained.
Wait a minute. Huh? What did you have? Is it dinner time?
No.
What mama say?
Is it dinner time?
What snack are you getting?
Chips.
Well, go ahead.
Can I get one too? Barbecue, please.
Round up family. Yes, who was that? Khalil. I work from home, bro. Plus, now it's a pandemic. I don't want my wife's pregnant. Get your questions in, round up. Go to my website, get all my stuff half off, 50% for the remainder of the month. I know I did it last month, but I've extended it. Good questions, Jeremy. I want to hire you. Jenny says she loves the way you want it. She wants you to hire. She says she promises to make her first month payment. How does she get in touch with you, Jeremy?
If you can't, call your servicer. There is a solution. No, but seriously, I'd love to help whoever needs help. I know last time we did a video, I actually got a lot of calls from around the U.S.
Yeah.
We do business in Virginia, Maryland, D.C., Delaware, Florida. We were approved in those 5 states, and we actually have business in all 5 states, which is pretty cool.
Good for you.
We are pending in, I guess I can say, we're pending North Carolina, and I'm waiting on my name approval for New York. So North Carolina, I hope, comes up within 30, 60 days, and hopefully New York by the end of the year at the latest.
So if she wants to talk to you, if she is in one of those states, Jeremy, does she go to, I think Facebook is your main thing.
Yeah, Google me, Jeremy Harridath. I should come up.
Right
my
there.
phone number, 917-582-9874.
He's on Facebook. I would go to Facebook, send him a direct message. Personally, I would think be best. Mr. Thinker Brain. Can I get a VA loan to buy a duplex? Live in one side, rent the other. What's the highest amount in loan dollars will a VA rent do for him with a credit score of 500?
So VA doesn't have a minimum loan amount. There's no purchase price gap or caps. Initially, anything over the high balance county limit, the client had to put 25% down of the difference between the purchase price and the county limit. That's no more as of January 1st. I think it's called a Blue Water Act that Trump passed.
Mm-hmm.
To keep it short, you could finance a $1.5 million property if you wanted.
On a duplex.
I don't think duplex has any restrictions. I can double check the guidelines. I do not think there's any restrictions. Again, I can confirm that. I can circle back on that if Mr. Thinker wants to leave his or her email. I guess it's him because it's Mr.
Mr. Thinker, just send him a message on Facebook. He'll get this straight.
My email is Jeremy. It's my first name, Jeremy, at peace, PEACEHL.com. So peace, H is in home, L is in London.com.
Good one. Mr. Thinker, I think it's best to go to Facebook. Just type his name in.
Yeah, that works.
As a mortgage professional, Jeremy, do you really see credit score continuing to be the crux of the probability of future payments of clients? Good question.
It's a good question. And I think it comes down to the person who knows how to have savings in their accounts.
Manage money.
Manage money.
I'm preaching it till I die.
Yeah, I know in history and all the reports that come out, historically, your 580 client has a higher likelihood of defaulting on a loan.
This is not you talking here. This is strictly from numbers from the past.
You know the numbers, right? Someone can pull up the numbers. I've looked at it before. Don't ask me where. They could be dated. If someone wants to find something new and show me otherwise, I'll happily take it and change my thought process on it. But that's why these minimum credit scores are increasing across the board with different lenders. Now, in this environment, no one knows. Knows what's going to happen in 30, 60, 90 days, right? We can, again, be back to normal, or it can go really wrong, and the mortgage industry will be the last thing anyone's thinking of.
Yep.
Right? Just during this time, I hope viewers are keeping as much money as they can, not spending money on stuff they don't need. Remember, food, clothing, and shelter are the three main necessities of life. Anything over that is a novelty.
A bonus.
Water bottle is a novelty. Your telephone, well, kind of required in today's world, is still a novelty. If you can't make your phone bill, cancel it. Right? It's better off you cancel your cell phone bill and put food on your table versus paying your phone bill and not putting food on your table, or saying you can't pay your house because you have to put food on your table, but yet you're spending money elsewhere. It's just a matter of priorities, man. And I'm not saying that as a mortgage broker. Please keep that in mind. I'm saying that just as a person going through this time. Yes, we've had a good run at being a mortgage broker, but we're also, even with employees, like, for example, have you heard of the SBA loan that they're giving?
Yeah, I applied for that.
I didn't apply for it. Not because I don't need it, it's because I think other people need it more than I need it at this point in my career.
At this point, but Jeremy, you have no idea what's going to be in 3 months, though.
That's okay. But if I didn't figure out how to have some sort of finances in play, I planned for this before I opened up the brokerage. Just because we're going through something now, it would be my fault if I didn't figure out how to hire someone and not pay him for the next 6 months and try to figure it out, right?
That's sharp.
Who knows what's going to happen after 6 to 9 months, but
we don't.
Does that make sense? I mean,
I got you.
Yeah.
My brother said, don't be deterred. Don't fear. My brother's on. Hey, Brian, what did you mean about 5%? I'm presuming he means 5% down payment. 5%
down payment. So depending on where you live, Brian, if you can Google Fannie Mae high balance or conforming limit. Fannie Mae conforming limit. In Northern Virginia, it's 510-400 with a high balance amount to 765-600. Up to 510-400 on a loan amount, you can put 3% down. Anything with a loan amount over 510-400, your minimum requirement's 5% down. Up to 765-600.
Gotcha. Rich Terror says, "Hey, my brother Jeremy, he's looking to use his business credit as a down payment for long-term financing for rental properties. Do you think you would be able to help him?"
I normally would say yes. There is a commercial broker that I've been working with, but I don't have a short answer is no. We're not brokering business credit until we can expand our portfolio on the amount of people we can send business to.
Well, he just says he wants to use it as a down payment.
Yeah, but if he's using
borrow it for some.
If he's using business credit, he's probably going to put it in an LLC.
It is, no doubt.
Yep, and that will be considered a commercial loan at that point.
Gotcha.
Now, if someone's using their personal credit to buy an LLC, I have an investor that does that, but here's the big but. Due to the changes that have been happening over the last 30 days, I don't know if they still do that. I would have to check into it. Mm-hmm. And it's not our bread and butter. We don't do many of your LLC purchases. where we shine.
Queen Molly Harris, where can she find your info for FHA loans? Is it yours or is it?
I don't know, but you can call me 917-582-9874.
Gotcha.
That's the cell number.
Jeremy, he's listening, but let's do an actual real life situation. Wow. Okay. Credit score is 680.
Sure.
What's the chance of him getting a loan, or her? I'm sorry, him or her. And with this, is this a good time? And can you walk him or her through FHA or conventional? Which one would be good?
Sure. So
maybe we'll do a live pre-approval. Jay, would you be willing to do something like that?
I wouldn't mind.
One of my rounduppers, like, look, you trash or you good.
I wouldn't mind doing that once
That'd
they
be sharp.
Of course. Last thing I need is a privacy policy issue on my hands. No, seriously, if it depends on your down payment, depends on your debt to income, and it depends on the specific guidelines associated with your loan file. Let me back up. If someone has
2,000 foot now,
3% down payment, keep in mind anything less than 20% requires mortgage insurance. Now, that can be in the form of monthly mortgage insurance, lender paid mortgage insurance, split.
What is mortgage insurance, Jeremy?
Dive into the different types, but it ensures that the lender is paid in case the client defaults. It was what another person mentioned on the questions that I didn't want to comment to specifically. But mortgage insurance is priced off a credit score, and it's priced off a down payment. So the lower down payment you have and the lower credit score, the higher your monthly mortgage amount will be for your mortgage insurance. So to simplify it, if your score was at 800 and you're putting 3% down, I would not put you into an FHA loan because your mortgage insurance rate will be much lower than an FHA loan. Remember, FHA, they have a premium of 1.75 that's paid upfront and financing the loan. And then there's a 0.85 for anything less than a 5% down payment that's on the loan for the life of the loan.
Wow.
So if
that's high.
Putting 5% down with a 680 credit score, the mortgage insurance may end up being slightly more than an FHA, and the rate may even be higher than an FHA. We would just have to do a comparison to see, okay, does a person qualify for a conventional loan? Are we receiving an approval for a conventional loan? So just because a client has a 680 or even a 620 doesn't mean Fannie Mae will give an approval. Remember, Fannie Mae is also tightening some of their belts with the approvals on the back end because they know what's coming. So keep in mind, just because you have a score and you meet the guidelines doesn't mean you'll be approved. We have to do our due diligence to ensure you meet all the other parameters, and then that Fannie Mae or Freddie Mac will approve you.
Gotcha. Jerry, I want to go ahead.
It's a coin toss. We'd have to dig into the nitty gritty of your file and then see if we get an approval either way.
Jerry, I want to and I got to add on to this because I was introduced to private mortgage insurance the hard way. I got a loan, and then when I went to closing, I saw this $98 on my mortgage payment, and I'm like, well, my payment was $850. Why is it? I'm sorry, my payment was $780. Why is it $880?
Right.
Round up. I want you to understand private mortgage insurance. Let me paint this for you. It's like car insurance. You go out there. If you don't crash the car, you don't have any problems. Mortgage insurance. If you don't pay the loan, this private mortgage insurance is going to pay that loan for you. If you default, basically you're getting insurance against yourself and you're paying for it. Okay. I need you to understand this because
with not paying your mortgage and not being hit on your credit report for a 30-day late.
Forget, I'm late. None of that. I'm talking about if they foreclose, they are going to cover your mortgage, not the payment. You're right. I'm sorry.
Yeah.
If you crash your car, they're going to pay the car off.
They protect the lender.
They protect. Yes. If you don't pay your mortgage, they foreclose, then the mortgage insurance will pay the lender the full balance. Okay. And you pay for it. This is another system that I can't stand, which is why we always put a down payment down. But if you get, Jeremy just saying, if you get a loan that's less than like 5%, you're private and you got more risk. Your mortgage insurance is higher. So just keep that in mind.
The lower your credit score, the higher it is too.
Okay,
right?
So two of those.
Yep. So it's based on
real
score and down payment.
Well, Jeremy, people, my thing is they break their neck, including me, to get into these houses. And then you're like, damn, private mortgage insurance is $2,000 a year. And then, you look at the life of the loan, Jeremy, that could be another $30,000 on top of the principal, Jay. Well, so I'm just saying, be mindful, very, very cognizant of what you're getting into when you're getting into these loans.
Yeah, just keep in mind, it's all a matter of risk, right? The higher score you have, the lower chance of you being a risk to not pay something. Gotcha. So the cheaper it'll be for you. But if someone has, for example, a 620 credit score, 680 is not a bad score. It's a great score, but there's something on there that's keeping it at a 680 versus a 740, for example, right?
Queen Molly Harris, will a lender FHA loan with 500? What lender?
Yeah, so 500 to 579 requires a 10% down payment.
Basically, you can have.
Now, I guess I can say this. What I've noticed with lower credit score clients, I've even seen this even at 620. If you're not being approved on your own, typically if you get a non-occupant co-borrower who's a family member or someone to help you qualify for that loan, it increases the chance of you qualifying.
Gotcha.
And then again, if you have a 550 credit score, you don't have any money for a down payment, or even if you have the 10% down, there's no reserves, there's no financial backing in case something were to happen. The likelihood of FHA, and I'm not saying they're not going to approve it. I'd love to take the application and see what FHA says. But if your profile isn't strong elsewhere, meaning your debt to income ratios are high and you're maxing yourself out, it's a higher risk for FHA and they may not approve that loan.
Gotcha. So I want to sum this up, Jeremy. Well, let me ask you, if you got some reserves, if you got cash to put down, people treat you differently.
The system reads that risk profile differently.
I'm telling you, every time 100% round up, when I'm bringing skin in the game, they don't even care. Matter of fact, my lenders, they don't give a crap about my credit score. When I do apply for these type of loans, they do care, but it's like my credit score is irrelevant. I'm putting down 30, 40%. I mean, they don't even care.
It's a catch-22 because I've also had clients. I had one client say, I have like $1 million in my whatever.
Yeah.
I could get this loan. I'm like, yeah, but your debt to income ratio is too high, and that can't be used as
big too.
The loan that we're doing. Like,
that is big too, Jay.
Just because you have an 800 score doesn't mean your shit don't stink. Right?
Okay.
It's probably the easiest way to say it.
That is true. So it's good to have reserves, low expenses, and a down payment.
There's a lot of different parameters.
If I had to put you in a box, Jay.
Yeah.
All right.
Credit payment. Yeah.
If I had a person that was declined a home loan with a credit score of 720 with cash reserves and self-employed, wow, that's tough. Why should they pursue a loan when it wouldn't make sense for them financially? Good question, Jamon.
Why was that person denied for a home loan?
Yeah, that looks like they.
Was it they made $100,000 during the year and they wrote off $90,000 of it to have $10,000 in income?
Probably. That's what we do.
Because if it's $10,000, you divide that by 12, your income's less than $1,000 a month. And if you're trying to get a mortgage payment of $2,000, the math doesn't work, right? Yeah. So a good amount of my clients are self-employed, and a good amount of my clients have more than one property. Again, we have a wide range of clients that we work with. So we know how to look at tax returns and explain recasting. Okay.
Gotcha. Jeremy, Edward, well, I'm sorry. I don't want to leave Jamon. Jamon is the guy's always.
I don't know what the situation is.
Yeah.
I don't know if one declined and why should they pursue a loan when it doesn't make sense? Then why did they apply for the loan in the first place? I'd have to wrap my head around what that scenario is. You can email me or call me or find me on Facebook.
Yeah, that'd be something. That'd be good to see. Edward, hey, can you go over recasting? I'm just learning recast. I'm embarrassed to say versus refinancing again.
Sure. Jay. Refinance is you take your current, let's say your current loan balance, which is $200,000, and you lower it to whatever the market rate is. Let's just say 3.5%, just throwing out a rate with a specific term, either it being 360, which is a 30-year. 300 for a 25, 240 for 20, 180 for 15. And you have a new payment based off of that new interest rate, new term. What a recast is you pay down your loan. Let's say you're at 250 and you pay it down 10,000 to 240. You can call your servicer and they will re-amortize your payment based on your remaining amortization. So if you've had a 30-year term and you've had it for 2 years, and you paid it down substantially, you can go ahead and have that principal and interest payment redone for the remaining term.
I love it. I like
that.
Now,
again, check with the servicer. I believe the guidelines are different for each servicer. From my knowledge, you would have to pay it down at least $10,000 in I think one sum. And there's to recast, it's roughly around $250 to $500.
Jeremy, I'm looking at all the loans that I've paid off. Let's say I borrowed $100,000, I paid it down, 90, 80, 70, 60. Are you telling me I could have called them to recast it at 50,000?
You can recast it, whatever the remaining balance is. but I do know you would have to pay it. You can't just make your normal payments and then have them recast it. Because it'll be recasted for the same amount. So 200,000, you have an amortization schedule, and every time you make a payment, your principal balance goes down.
Yeah.
Now, there's nothing to recast if you didn't change your principal balance along the way.
I'm talking about as I'm getting down 40, 50.
And you start paying it, and you sold the house, you paid down half of the mortgage. You can recast it for the remaining term, which will lower your principal and interest payment.
I know. I'm just asking you, how does the process? Do we just call up our lender and say, hey, I would like to see if you guys recast this loan?
Yeah.
Golly.
Find out what the guidelines are.
Why didn't I know about this roundup? Anyway, that's why I don't try to act like I know anything. I'm an empty bucket. Ah, boy. Roundup, get your questions in for Jeremy, mortgage broker in the East Coast, Virginia, Florida, Maryland, DC area. Jaquavis, sorry about that, Jaquavis. A property that's 50,000 move-in ready. It's gonna be hard. The owner lives out of state. What do you think him taking out a personal loan after getting an equity loan due to him not being able to put down 20%? Good question.
Personal loan?
You can't help him with that, can you, Jay?
I mean, I wouldn't be able to help with a personal loan. But if someone's going to give you $50,000 to buy the property, you can do that. And then you'll be able to do a cash out refinance after the fact up
Good idea.
75% if it's an investment property.
Yeah, I think that's a cool idea. Jar Cuevas, good idea. Or I'll give you a link to one of my lenders with Fund and Grow. You can get my discount. Mary Jane, is PMI private mortgage insurance that I hate? I cannot stand paying it. Is refunded at any point in time, Jeremy?
So PMI referring to a conventional loan? No. There are some options for refundable option.
What?
But those premiums are actually higher than your non-refundable options.
Man,
so it can get a bit hairy and a little bit 40,000 level conversation. In short, our clients just do the lowest payment possible as opposed to taking the higher with the chance of having a portion of it being refunded. Gotcha.
Jerry, would it be better to buy a house without PMI? Well, you don't have that option, Jeremy.
You can do so. So here's the thing. There are some lenders that will say you can finance 100% of the property with no PMI.
What?
That comes with a higher rate.
Oh, well, it's still the same money out of your pocket, though.
Yeah, it's just allocated differently, right?
Explain that to Jay. Go break that down. This is good stuff, Roundup. I should get
if you can get a house putting 3% down at 3.5%, and you have monthly mortgage insurance that's $100. Someone else may do a loan with 100% financing with no PMI, but your rate.
Stay here. Hold on, Jay. Option A, with PMI, your payment is $1,400
without crunching the numbers.
But option A, $1,300 loan payment, $100 PMI, total $1,400 out of your pocket.
Yeah, but I'd have to crunch the numbers if I'm going to give a
whatever it is.
Your payment can be higher with no money down and no PMI. I mean, there's a company that does them, Navy Federal, for example. They'll do 100% financing, no PMI loans, but your rate's higher and you pay origination fees that are funded into the loan, financed into the loan. It's a higher way of purchasing a property with putting no skin in the game, but you pay for it. So you're going to be upside down walking into that house before you even make a mortgage payment.
You don't want to do that. Jeremy, option A, whatever the loan amount is, whatever the interest rate is, we're talking $1,300 a month, $100 PMI. That's $1,400 out of your pocket every month, right?
Okay.
Option B, $1,400 mortgage payment, no PMI.
Okay.
I'm asking you, is that what it looks like? Is that the overview?
I can't answer that because I don't know what the specific numbers are. Again,
generally speaking. No. I'm just saying, generally speaking.
Chances are your payment's going to be higher at the 100% financing, no PMI range.
Maybe $1,450. I'm just trying to paint a picture so they'll see it.
Possibly be higher.
Okay, cool. I'm not trying to.
Credit score too, because I've done loans with clients putting through I wish I can give you an example. Actually, I'm going to give you one. You mind if I pull up an old loan that I closed?
Oh Lord, bring it on, bring it on. Round up. We got Jeremy Harridath here. We're getting deep today. What else are we doing? Right, we're sitting at home. I love talking about money because I love it.
5 minutes, but I enjoyed talking to you, man.
We got money and houses. They don't mix. America and our society has mixed them, which gives Jeremy a job, allows us to have credit defaults, to put money on houses, right? So it's not the house's fault that you owe $1 million. It's not the house's fault that it's paid off, right? We've mixed these things together to create security in our market. I don't like it, but it's how it is.
No, this guy had a 7.
Get the questions in, round-uppers.
Thinking who had a really good...
You want to share your screen, or is that privy information you're looking at?
Yeah, I wouldn't want to share that for privacy. And this guy was good. He had a good score.
Napalm, what up? Got the brightest. That's right. Jeremy's one of the best and brightest. I like that guy. Go ahead, Jay. I'm still looking at these questions.
I'm still looking here too. I'm just trying to find
my question.
I think would be really good.
Banks get paid twice. That's true to the homeowner. Should not be put in the position to pay a loss from the short sale, etc. Could be. They're getting that mortgage insurance. And even the government bailed them out back in the day.
Actually, I think this...
Brother doesn't feel bad for renting. I feel you. I ain't even mad at renting. He got a 750. He good to go. This is good. Levon, thank you for chiming in, as you guys are no doubt at home. Staying healthy. Marcus, debt to income is very important in financial times now.
So Fannie and Freddie allow approvals up to a 50% debt ratio. Freddie Mac will actually go to 50.499 because they round down. But some investors have lowered their debt to income ratios to 45 and even 43 as a firm number.
Gotcha. Do you think that's going to be changing, Jay?
And they pre-approve you for a certain amount. In opinion, if you truly need to purchase more.
Is that, or are you thinking DTIs are going to change, Jeremy?
Yeah, I think so. It's already happening. Yeah. I have for the last week, I've had investors change their guidelines, and I had a few investors not taking any more business.
Wow.
So
when you say investors, just break that down so we understand what you mean by investors.
Some players on the back end have decided not to take in any new originations until all this clears. I had one company yesterday say they're not doing any government loans until all this clears. Again, there's a lot happening on the back end. All right, so I got one here. This is a $450,000 purchase. Okay, I did this loan back in May of last year. Okay, just to give you an idea of where rates were, and this rate, freaking competitive. I remember this guy shot me with 3 other investors, and he still stayed with me. Not only because my rate was lower, but the other 2 investors said they couldn't do it because they didn't understand commission guidelines, and I just knew the guidelines. So he financed 436,403. It was actually 449,900. He put 3% down. His rate was 4%. His principal and interest payment was $2,083.43.
That ain't bad.
His mortgage insurance amount was $113.
That ain't bad.
Escrows were $432. Total payment of $26.28.
Okay, taxes and insurance on top of
taxes and insurance, correct. So out of that $26.28 payment, $113 was MI.
So what would have been Jay on the?
Even if you can put 20% down, here's my thought process, and here's actually why I like MI, right? For a counter argument. Let's say you can put 20% down. Let's say you're buying a $400,000 property and you have $80,000 to put down. Here's my recommendation. Put 5% down, maybe even 3%. Where do you want your payment to be, right? We're focused on how much we want to finance. Now, if that person who wants to finance $320,000 since they want a $1,000 payment, they're unrealistic, right? I already know they don't get what a true payment can be. But if that person says, well, I want to have a $2,500 payment, well, then I'll go, how about you put 5% down? Your payment will be $100 higher, but you'll have $50,000+ in the bank in case of a rainy day. like today, as opposed to putting $20,000, 20,000 or not 20,000, 20% down payment, using all your cash, having a very low payment. But now, if something happens with your job, you have no reserves.
That's true, Jay.
I actually, most of my loans, even though clients can put more money down, I typically recommend putting less and having cash in the bank.
That's a good point, Jay. Especially right now.
5%, 10% down. It makes sense.
That's a good point. I'm thinking, well, most of the houses we buy are investments, so we're going to get rid of them. But we're talking about owner occupant with you.
Right.
Good point, brother. Marcus, Nikki, hey, client asked about whether she should do anything about accounts showing closed and one showing charged off. Both accounts have been on credit for 3 to 4 years.
Accounts showing closed? I mean,
I don't know if that's a question or not.
Accounts aren't being reported again if it's closed. I mean, unless they were derogatories, that was the factor into the score.
Gotcha.
Charge-off should always be paid off. Now, not all the FHA says charge-offs don't have to be included and nothing has to be done unless it has to be manually downgraded. Conventional, you have to review your findings and it'll tell you if it needs to be addressed or not. In order to heal your credit score, that charge-off has to be addressed.
Gotcha. Good one. Brian Knight, hey, can you lock up a partnership with an LLC or land trust? Yes. And how? I'm bringing info and money and my partner using credit. How does he lock it up?
That's for you, Chris. I'll let you lock that up.
Yeah, you can lock it up, my friend. You already know me, Brian. If you follow my content, I'm a land trust guy. I don't care about LLCs until you've got your land trust set up. Your LLC is on the back end of that, or is going to be the beneficiary of that trust. So just create your trust, have you and your friend or whoever your partners in that trust, and it's over. End of story. It's over. Okay, lock it up, brother. Lock it up. Use your trust. Both of y'all on the beneficiary. Your partner will sign for the loan. You don't necessarily have to sign for the loan because he's using his credit. We've done that I don't know how many times. You better record it though. Record and use your partnership too. I would highly recommend you to have a partnership agreement too, so you can record it against the property. They can't sell it until you sign. Jerry, can you recast a subject to after taking over the payments? That's funny.
A subject to? What's a sub to?
A subject to, like we have something called creative financing, Jay. Like the house I live in, right?
Right.
Loan's not in my name. We just come in and we take over the seller's payments.
Your servicer determines a recast. So you don't go to a lender. You don't go to a new lender to recast your loan.
Nah.
You go to a servicer to recast your loan. So
can't do that.
Whoever you have your loan with.
Jamal was talking about that one earlier. They were looking for a $600,000 home. They sold their business to get the down payment and reserves. Bank of America said they didn't have enough seasoning on the money. Yeah, that's true. Seasoning. Jeremy, explain seasoning a little bit. Quickly. I mean, the 10,000 foot view, bro. Don't.
It has to be in their accounts for at least 60 days. So, meaning, if you go to a Bank of America, actually, Fannie Mae and Freddie Mac determines how many months of bank statements you need. Individual banks may say it's 2 across the board, but in reality, it's whatever Fannie and Freddie says, at least for us.
That's right.
So if we have a bank statement where the beginning balance is 60,000 and the ending balance is 60,000, there's no question on the 60,000. But if we have a beginning balance of $500 and the ending balance is 60,500, we're going to ask where that $60,000 came from. Now, if they sold their business and we can document it, yes, we can use that income because it's not income, that asset, because it's documented. But if I got $50,000 in my mattress and I want to go ahead and just put that in the account a week before settlement, that ain't going to fly.
They want to know where the money's coming from.
Right. And I'm happy to chat on that more. Just call me or email me. We'll find a solution.
That's how we got into this problem now. People borrowing money. Let me hold this 20. Let me hold that 30. Give it back to them. It's not even their money. Marcus, do you see the housing market? Marcus Lane, hey, brother. Jeremy, do you see the housing market changing like it did in 2008? Prices tanking, making more inventory for buyers, Jeremy?
No one knows what's going to happen. I'd love to give a hypothesis. Ideally, trying to be optimistic about this. I hope it's not as bad as 2008. Before 2008, was because we were lending to people that shouldn't be buying. Remember, you can just put on an application that you make $250,000 and that was it. Now we have a virus that's worldwide spreading, and that's causing
global.
It's a global issue, but I'm a believer that it will get through it quicker than I at least hope so, right? Because I don't think we need to worry about housing if this virus keeps getting worse. It's more of an issue on survivability, right?
That's true.
Because the whole economy could tank as an extreme worst case.
Yep.
I try not to go that route. I would say be prepared regardless and just keep your cash if you can.
Lavon, is it true that you could pay off your mortgage quicker on a line of credit under simple interest than letting it amortize on a regular mortgage? I'm thinking she's taking a line of credit and paying them principal down.
Yeah. We have a loan that we can broker called an all-in-one loan. And to keep it on a very simple level, you get a checking account and you get a line of credit, essentially. And let's just say you're buying keep simple numbers, $400,000 house, you're putting 20% down, you're financing $320,000. Well, on a 30-year note, so you see my fingers, that $320,000 will be paid over time. And then it's much quicker at the end paying down the principal. So it's more interest you pay to start, less interest you pay at the end. This all-in-one loan, it is a simple interest loan. You pay interest per day, daily interest. So you start off at $320,000 and you have a checking account at $0. The way it works is your direct deposit comes in, $5,000, right? That goes into the account. Your balance on the mortgage goes from $320,000 to $315,000.
Oh, wow.
Now interest comes out of the account because it's daily interest that you pay. So instead of $4,000, let's just say now it's $3,000. Okay, just hear me out. Now your balance goes up to $322,000. Now next month you get $5,000 again. Your balance increases, balance goes down. So by getting your normal direct deposit and having cash flow, you can pay off your mortgage quicker. So once your checking account hits $320,000, you don't have a mortgage payment.
You got some stuff on that.
Based off of a 30-year amortization schedule and comparing having your normal balance go in, that you will pay off your mortgage sooner. So the short answer is yes. If you manage it properly, a daily interest loan can be better for you. And we do offer a product that we can broker out.
Nice. That's nice. Yakosa, hey, what about VA loans? What are the status of those?
No. Unless our investors all pull the plug, we do have homes for them. Gotcha. I called one today, the same company that they're actually very strong in VA pricing today. I priced one out, and I think I beat out like 3 or 4 other lenders. I just need the client to commit. I don't know what's slowing it down. They're a little busy, but that same investor said they're going down to 600, no change in business. They have a few overlays, but they're minimal. Nice. So we have investors who will go down to 550 on VAs. Again, majority of our clients have higher credit. They have the 740, 760 credit score. We do have clients that have 580, 600. That's not a base of our clientele, but we do help those clients if they need help.
Gotcha.
So yes, we do VA loans. We're still doing them. We haven't stopped.
Thank you. Jeremy, we got them all. Round up. We made it. 50 questions. We did them all. Jake, thank you, my brother. Round up. Don't forget, head on over to my site, get all my stuff 50% off for the remainder of this month, or as long as we're in quarantine. I can't be not getting ahead for that. Everything's half off. Jeremy, final thoughts on people that want to borrow money in the traditional way.
Yes. Now's a good time. If the numbers make sense, do it. Don't wait thinking the numbers are going to go one way or the other. If the numbers make sense now, commit now. You will lose a lot more sleep than you realize, hoping it goes one way or the other. You'll have more peace of mind just getting it over with and moving on to whatever else is important.
Just get it over with.
Buying a house is not the biggest investment of your life. It's not the hardest process.
Really not.
I don't believe that crap. Just buy the damn house, move on, and when you're ready, go buy something else. Like, it's not hard.
Well, Jeremy, I think you do it. Well, we do it so much. I mean, I really would love to just take some of your energy out of us, put it to my round-uppers, to minimize buying a house. It's really, I mean, literally, it is just you sign a deed and the loan and it's over.
Right. It's not push button, get mortgage easy, right? I mean,
but it's still paper. It's just paper.
Right. You are committing to making a mortgage payment. So pay your mortgage, right? During this time, the politicians who pushed this idea out did not realize some of the consequences on the back end, nor are they experts on the back end secondary market and what can happen. And like all decisions that are made externally are pushed due to votes because in the end, that's kind of what it is for. It may not be for the greater good. So understand that you not making your payment can hurt the system as a whole. If you're going to get a loan and you're going to be getting a house in the near future, understand that. Don't think that you can just buy a house and not make your mortgage payments for 6 months.
That's true.
Don't do it. Like you're shooting yourself in the foot more than you realize. And when the system breaks, know that you were the one throwing stones at the glass. So
got you. Well, I think that's a lot of the problem in 2007. I remember selling, Jay, I've literally bought houses twice. You know, I sold it to the guy. They didn't pay. We got it back, foreclosure. Sold it again. I'm like, man, these people, you know, people really, things happen.
I hope that doesn't happen. And again, we got, that time was due to the U.S. or the mortgage market just not,
greed.
Again, I can be a strawberry farmer making $250 and I can go buy $1 million house down the street. Not saying that was the blanket for all mortgage lending. Don't get me wrong, but again, what's happening now is not due to mismanagement of mortgage funds. It's something global. Just be safe out there. Keep your cash, food, clothing, shelter. Use whatever cash you have to make sure you're set on those.
Gotcha.
Don't buy unnecessary stuff if you can avoid it.
Thanks, Jay.
Just prep yourself to not panic. I mean, don't let fear. What would the other guy say? Don't let fear win.
Yeah, he did. That's my brother. Yep, he did say that.
Is that
round up?
Valuable?
Huh?
Was this valuable? Does this help? Is it good? Did you enjoy it?
I did. I learned a lot. I learned two things. That what was it? Not refinancing, recasting. I'm like, and then that other thing about the private mortgage insurance. So much stuff to learn, right?
Yeah. Well, be safe out there, Chris. Hopefully I see you in July. Thank you for the opportunity, man. It was fun.
Yeah. Okay. Round up. Make sure you subscribe to the channel, hit the bell, share this with other people that could possibly be interested in buying a house and getting a loan. Maybe Jeremy could help them. And stay tuned. You got to hit the bell, like the content, hit the thumbs up. The bell is going to let you know all the experts we have coming on to help you maneuver through these crazy, uncertain times, like Jeremy. Okay, my round uppers, I love you. I will see you soon. God bless you. Bye.
Later.